Hello and welcome to Financial Planning Unlocked, brought to you by Rathbones Financial Planning, where we look at key financial planning topics for you and your family. The contents of this podcast do not constitute a recommendation or advice, and no action should be taken without seeking advice from a financial planner.
Hello and welcome to this podcast. I'm Christy Lombard, certified financial planner and tax-advantaged investment specialist. And today, doing his first ever podcast, I'm joined by...
That'll be me, David Nelson, and I'm one of the senior financial planning directors based here in the London office at Rathbones.
Thanks, David, and welcome everyone. Glad to have you listening in as we discuss some of the background and intricacies of inheritance tax.
Yeah, inheritance tax, which has to be one of the most widely misunderstood and also deemed to be most unfair taxes that we have. On the misunderstood part, I have noticed a survey conducted by Opinium in February 2024 that showed a quarter of people over the age of 55 did not know whether their estates will be charged inheritance tax, and almost 30% believe their estates will be taxed upon their death. There was also a YouGov poll back in September 2023 which showed that 61% of Britons believe that inheritance tax is unfair.
Did the polling state a reason for why people feel it's unfair, David?
Yeah, the reason that most people feel it's unfair is because it's viewed as a form of double taxation. People feel that they are taxed on death on assets that they've already been taxed on. Look, it's great to share the stage with you today, Christy. As a specialist, there will obviously be some more technical areas where your knowledge will be of real value and interest to our listeners.
I hope so. I think we'll make a good team given you're still practicing and advise clients daily on these subjects. It will be great to hear some real life client examples which may resonate with some of our listeners and hopefully help bring some of the theory to life. That said, inheritance tax is a big subject and we're only putting out 2 easy to follow podcasts, and so we're limited on how much we can cover. The subject matter we will cover in these 2 only covers the situation for UK resident and domiciled individuals. So if you are one of our listeners who are uncertain about these terms and whether they fit and if you fit both or one category, please make sure that you seek advice.
Yeah, absolutely. They should, because planning required can be really different for those individuals. Okay, so we've decided to split these sessions on inheritance tax across 2 podcasts. In this one, we are hoping to give you a good introduction to the framework that we have here in the UK. And in the second, we will cover some of the things that our clients will often consider when it comes to their own planning.
And I think probably worth recommending that our clients do listen to them in order, as they're likely to be things in this session which will help them understand the next session. Okay, let's kick this off, David. Here's one for you. So inheritance tax, as we know today, was introduced in the 1986 Finance Act. That's not really so long ago. If we look at income tax in this country, that was introduced in 1799.
No, you're right. And I think that many people would be surprised by the fact it's only been around since 1986. Inheritance tax was introduced then to replace capital transfer tax, which itself replaced estate duty. So in essence, the taxes themselves were pretty similar. Now, inheritance tax is often abbreviated to 3 letters, IHT, and IHT receipts account for less than 1% of the government's total revenue.
1%. That doesn't really sound like IHT is a huge contributor, but actually the tax that's collected through IHT is growing, and from April 23 to Feb this year, just shy of 7 billion was received. That's £400 million higher than for the same period the previous year. And this is despite the fact that only 5% of estates pay IHT. Yeah,
that's right. The percentage of estates that do actually pay IHT is low, although the numbers are often masked by some of the exemptions. Also, as you know, with proper planning, there's a whole raft of different inheritance tax reliefs that can be utilised. And there are numerous ways that people can arrange their affairs to effectively mitigate inheritance tax becoming payable on their death.
On that note, would you mind sending out some of the UK's IHT framework for us?
Yeah, of course. So as I mentioned previously, we're only focusing on individuals who are UK resident and UK domicile, who are subject to UK inheritance tax based on their UK and their worldwide assets. So the way that IHT works in the UK is like this. The rate of inheritance tax is 40%, and this applies on death to an individual's UK and worldwide assets, but excludes certain assets, of which the most common is a pension plan. There are some exceptions to this, but these are rare. And also anything that's left to a spouse or civil partner is also exempt of IHT.
Sorry, David, I'm just going to jump in there. It's really important to note that this exemption does not apply if you're simply cohabiting with your partner. So the length of time you've lived together or the fact that you might have children together does not change this. So it's really important to know that if it only works if you're a spouse or civil partner.
Yeah, that's right. Thanks, Christy. And that actually brings me on to my next point, that everyone is entitled to their own IHT allowance, and this is called their nil rate band. It's currently £325,000, and this is the amount that someone can pass on to their beneficiaries free of any tax. So where you are cohabiting with a partner and you leave your assets to them, this will use up some or all of your nil rate band, and anything above the £325,000 allowance could be subject to IHT at 40%. Another valuable allowance that was introduced in 2017 is the residential nil rate band. This applies when a property is left to children or other direct lineal descendants and is currently £175,000 per person. However, this reduces for estates valued over £2 million.
And just for clarity, direct lineal descendants includes both adopted and stepchildren. There is a full definition on the HMRC website, just to provide a bit more clarity on what that actually includes. So, David, essentially individuals with estates below 2 million who have direct line descendants that they want to inherit their primary residence boosts their inheritance tax-free allowance to 500k.
Yeah, exactly right. So if you're married or in a civil partnership, your partner can also inherit any of your unused nil rate band, including the residence nil rate band where applicable. So a good example that we often see is that couples can now leave assets worth up to £1 million before having to pay any inheritance tax, assuming that their estate is less than £2 million and they have their full inheritance tax allowances available.
And for those with estates of more than £2 million, your residence nil rate band will reduce by £1 for every £2 over the 2 million. And I know you have really simplified this, and there can be many other things to consider. For example, if your main residence is held in a discretionary will trust, you have sold the family home to enter a care home, etc. So, it's really important that our listeners do take advice to ensure that you understand if the residence nil rate band applies to your circumstances.
Yeah, I mean, there really are so many different aspects to consider. And the use of trusts, for example, is definitely one of them. Trusts are a whole topic on their own, and although they can be valuable vehicles for your estate planning, they can bring complexities. The right advice can ensure that you are making best use of the allowances available and which strategies are available to reduce your IHT liability. There are also certain assets that qualify for specific reliefs like agricultural relief and business relief, and these assets can be passed on free of IHT. Christy, do you want to explain a bit more about those?
Yeah, absolutely. We're going to delve a bit deeper into these in the next episode, and we'll cover some examples. But to keep it simple for now, essentially these are valuable reliefs from inheritance tax, which the UK government introduced to encourage entrepreneurship and the passing on of family businesses like farms without burdening the heirs with substantial tax bills that they previously would have been subjected to. So some of you may also know this as business property relief, which it's still often referred to.
Okay, so essentially, Christy, business property relief serves as an incentive really to keep family businesses intact and thriving throughout the generations.
Exactly, David. It was introduced to prevent the breakup of family businesses due to the hefty inheritance tax bills that would be payable. Often family businesses would have to be sold or torn apart to pay the bill and help them pass on to the next generation. So the relief can apply to a wide range of business assets, including shares in qualifying unquoted companies, certain types of land, buildings, machinery, and other business assets as well.
So it's not just about preserving wealth, but also preserving the family legacies and ensuring the continuity of the business.
Precisely. There are providers that focus on offering products that ultimately invest and manage business assets that qualify for business relief, that both individuals and trusts can invest into, which potentially have the same effect as business relief. And I think one of the really important points to mention before we move on is that the qualifying status of assets is only assessed on death. So the business relief is only assessed when a person dies. So it cannot be guaranteed beforehand, no matter how many structures you put in place thinking they do qualify. I know we'll cover this a bit more practically and give examples in the next episode. David, I know that there are many opposing opinions about inheritance tax, essentially a tax you are liable for on death. And I know you mentioned this in the beginning. in terms of being an unfair tax. And we also know, as you mentioned earlier, it can be one of the easiest taxes to reduce with careful planning. So what are the simplest ways to reduce your IHT?
Well, I mean, there are really so many options, but I guess the two most simplest are to spend it or to give it away.
That's pretty easy to remember, it sounds like. I think I would definitely want to spend it, but let's unpack this a bit more.
Absolutely. So just looking at some of the various gifting exemptions available, we each have the £3,000 annual gift exemption, which is an amount that you can give away to anyone in any one tax year. There's also a small gift exemptions of up to £250 per recipient per tax year. You can make as many gifts to as many people as you like using that exemption. You can also make gifts on marriage or civil partnership, which can range from £1,000 to £5,000 tax-free, depending on the relationship to the donor and donee. And gifting to charities have no limits at all. And probably the most underused of all the exemptions is gifting money out of excess income.
David, you mentioned the small gifts allowance of £250. Now, this exemption has remained unchanged since the introduction of inheritance tax in 1986. Obviously, £250 was a lot more money back then, and now would probably only get you a pair of good theatre tickets. Yeah. So how does this impact the planning that you need to consider for clients?
Well, I mean, it definitely means that we have to find smarter ways to reduce our clients' IHT liabilities. And it is why I say gifting out of income is often a useful tool that's not widely known or used. It does create a bit more admin for the donor. They need to make sure that the gifts are not affecting their lifestyle, but essentially there's no limit to how much can be given away using that method. You can also make much larger gifts, but these attract what is known as the 7-year rule, which some of our listeners may have heard of. And we'll cover some real examples of that in our next session.
I know there can be some complexities with gifting, and a gift must be a genuine, unconditional gift, which I think often clients forget. I'll park that for now, as I know you have some examples for us in the next episode. Earlier you mentioned spending your money as a way to reduce your IHT bill, and I know that's probably what I would like to do, but how open are your clients to actually using this option and spending their cash?
Well, often clients are a bit too nervous to spend their hard-earned money. Either they're worried about running out of capital to support their lifestyle, or more importantly, later life care should they need it. Then the topic of gifting comes up, which again can bring up concerns of not having sufficient capital for their own use, but also how much they trust their children or beneficiaries of their gifts to use them for the intended purpose.
Okay, so maybe not as simple as the two words suggest, spended or gifted. Interesting, you mentioned later life care. We have recently published our 2023 financial wellbeing research, where we had over 1,000 respondents for the first time. So we are delighted with the insights we've gained. And intriguingly, 85% mentioned the importance and their concern of being able to pay for later life care. Yeah. This is a much higher figure than we've seen in our research previously. Is this something that you have seen with your own clients, or something you consider with clients now?
Yeah, I mean, it's becoming more and more of a topic of conversation. And maybe it's because a number of my clients are now seeing the cost of care of their own parents. And that's probably something that previous generations hadn't seen so much before. A lot of the work that we do as financial planners is quite different to what I think most people believe we do. We focus on a client's lifestyle, family dynamics and situation, and the legacy they want to leave, what scenarios we should be planning for and be mindful of. And bringing this back to the subject of inheritance tax, often the planning we do results in tax reductions or benefits, but because our focus is on the client's goals and objectives, those tax reductions are not often the main drivers for what clients want when you get into those deeper discussions. That said, knowing some of the nuances of the IHT framework can really help the effectiveness of planning for clients.
David, just picking up on what you mentioned in there in terms of legacy. So in your 20 years of advising clients, we know another great way to help reduce the tax burden on one's estate is charitable giving and philanthropy. What sort of things have you seen or done with clients, and what benefit have these had in reducing their inheritance tax bill?
Well, absolutely, Christy. Charitable giving allows families to support causes that are close to their hearts, while also reducing the taxable value of their estate. Gifts to registered charities are exempt from inheritance tax, and where a charitable donation is equivalent to at least 10% of your net estate, you can actually reduce your IHT rate from 40%, as we've mentioned previously, to 36%.
Sounds like a win-win, and pretty amazing how financial planning strategies can align with the family's philanthropic goals, having a positive impact on society and leaving a potentially significant legacy.
Yeah, in most cases, yes. But I've seen it cause some family disputes, mostly once the donor has died and the estate's being distributed. And so I'll always try to encourage families to have these discussions early on while the donor is still around, because strategies like these can help not only to protect the family wealth, but also leave behind a meaningful legacy.
I'd love to pick your brain a bit more on that, but I know we have something planned in the summer, which is about holding a family boardroom, how to do this, why to do this, and who should be involved. So we'll leave it there, and hopefully our listeners will look out for that one. I think we've covered quite a lot in this first session. So if we could just summarize this for our listeners.
Yeah, okay. So in terms of some takeaways from this session, I guess if you have an estate worth £325,000 or less, then there is unlikely to be any IHT due. An unmarried sole parent leaving a property to a child or grandchild with an estate worth £500,000 or less, again, is unlikely to pay any inheritance tax. When you're married and you have no direct line descendants and a joint estate worth £650,000 or lower, again, unlikely to be any inheritance tax. If you're married with children or grandchildren and own a property which is going to be left to them, your total estate is worth less than £2 million, say, then there is unlikely to be any inheritance tax on the first £1 million on the second death. And sums above this are likely to be taxed at 40% unless you've chosen to leave more than 10% of your net estate to charity. I think one of the most important things is to remember that there is no IHT payable on gifts or asset to spouses. So if you feel that you are likely to have inheritance tax to pay on your estate, then you may feel that you have the rest of your lives to plan, and indeed you do. However, the earlier you start that planning process, the better the likelihood of you achieving the outcomes that you're looking for.
That's great. Thanks, David. Thanks so much for your time, and I look forward to seeing you at the next one.
Thank you.